What time frame should I use? This is the most commonly asked question among traders. In this video, I'm going to explain every detail that you need to know about time frames. You will learn the differences between different time frames, how you can choose the best time frames based on your trading style, what is top-down analysis, how you can analyze multiple time frames simultaneously, and the importance of top-down analysis for finding the best trading opportunities in the market. Without wasting any more time, let's get started. Alright, in trading, one of the basic things that you learn is price chart, a chart that shows the movement of the price. And the most common type of price chart is candlestick chart. This chart that you see here, there are different types of price charts, but candlestick chart is the most commonly used price chart among traders because it can give you more information about what happened during a time period. Then you need to choose a time frame for your chart, which can be from seconds, minutes, hours to day, week, and months. And this is the most challenging part for traders, especially beginners. To understand the differences between different time frames, you need to completely understand the basic element of this chart, which is a candlestick. Right now we are on 1 day time frame. So here the x-axis is divided based on every day: April 23, April 24, April 25, April 26. And for each day we have a candlestick which has 4 parts: opening price, closing price, highest price, and lowest price. If the closing price is above the opening price, the candle is green, and if the closing price is below the opening price, the candle is red. So for example, here in April 6, the market opened here at this price, and then the market closed at this price. This is the highest price during the day, and this is the lowest price. This is all we know about April 26. Different types of candles have different meaning and interpretation, but I don't want to talk about them in this video because here the focus is on time frame. In case if you're interested to know about different types of candles and candlestick patterns, I have a complete guide on this subject. The link is also placed in the description and you can check it later. Alright, now let's switch to 4 hours time frame and see what happens on our chart. When you are on 4 hours time frame, the x-axis is divided based on every 4 hours. Let me mark the area for April 26 so you better understand what is going on here. April 26 started here, so I draw a rectangle from here down to here. Alright, these are 4 hours candles for April 26. For the one candle of April 26 on daily time frame, we have 6 candles here. These are included in that one candle on daily time frame. But here we have formation of the candles every 4 hours. And this is giving us more information on how the price changed during April 26. Alright, now let's go to lower time frames, for example 1 hour. And now you can see we have even more candles. This is the same period starting of April 26, which is actually from here, because here we are on 1 hour time frame. We can see more precisely when April 26 started. So let's put the rectangle starting from here. This is where April 26 started, and this is ending of the April 26. Market is closed now. Here on this time frame, the x-axis is divided based on every hour. So one candle on daily time frame is equivalent of 24 candles here on 1 hour time frame. At the moment, it is less than 24 because the market is closed now. But during the week, you will see 24 candles. Here, the market is closed at 20 p.m. UTC time zone. So as you can see, because we came to lower time frame, we can see more movements of the price during the day. And please pay attention that in compared to 4 hours time frame, for one candle on 4 hours, we have 4 candles here on 1 hour time frame. Now let's go to lower time frames, for example 15 minutes time frame, and here you can see that we have even more details about the price and how it moved during this period. This is the same April 26, but here we have much more candles and we see more details, we see more noises because every 15 minutes a candle is formed on the chart. And when we switch to very low time frames, like for example 1 minute, you can see that we have lots of details, lots of noises. We can see exactly how the price moved during that period, the same period April 26, and how the price action performed during that day. You can see that here we have well established uptrend, downtrend. You can draw trend lines, support and resistance levels, and these are all happening inside one candle. This candle which formed here on April 26. Here on this time frame, all we know is that the candle opened here, it closed here, it went up to this price and down to this price. But the more we go to lower time frames, we can see more and more details of the price action. And similarly, 7 of these candles on daily time frame are just one candle on weekly time frame, or 30 of these candles are just one candle on monthly time frame. Alright, now that you completely understand the differences between different time frames and how they are interrelated to each other, you may wonder, okay, which time frame should we use? Choosing of time frames depends on what kinds of a trader you are. As you saw, the more we go to lower time frames, we see more noises, and the more we go to higher time frames, the noises are removed and we see less noises and more stable situation of the price. So shorter term traders go with shorter time frames and longer term traders go with longer time frames. Let me give you a guideline on different types of traders and the time frames that are suitable for them. Generally, we have four kinds of trading style, which are scalping, day trading, swing trading, and position trading or long-term trading. Scalpers hold their position from as low as a minute up to few hours depending on when the price hits their target. On average, they are in an open position for several minutes. Day traders hold their position not more than a day. They don't keep any open position overnight, and depending on when the price hits their target, it can be less than 1 hour up to several hours. And swing traders hold their positions from less than a day up to few weeks, and position traders from a few weeks to many months. Scalpers usually choose time frames from 1 minute to 15 minutes, day traders 5 minutes to 4 hours, swing traders from 1 hour to daily, and position traders usually use daily, weekly, and monthly time frame. Please pay attention that these are the most common range of time frames used by each category of traders, and as you can see, they have overlap. And please pay attention that depending on the strategy, you may also use other time frames than these. For example, there are day trading strategies that, for example, the trader watch 15 minutes and also daily time frame. This is just based on average of what time frames are commonly used by different types of traders. Alright, until now, I think you can understand how traders choose time frames. For example, a scalper who is engaged in opening many positions during the day, it doesn't make sense for them to use daily time frame for discovering trade entries. For the day, there is only one candle, and there is no way you can scalp or day trade on this chart based on the current candle. But when you are on a lower time frame, for example 5 minutes, you have access to detailed price action that happened during the day, and here you can discover trade entries to enter the market. Also, on the other hand, if you're interested in position trading, it doesn't make sense to use a low time frame like this. All these price actions happen during one day, and they don't help you if you want to keep your position for several weeks, for example. Instead, you should be on a higher time frame like 4 hours or 1 day, so you can see longer term movements of the market. All those price action on 5 minutes chart are here included in this one candle, and they are just considered noise and not helpful when we want to open a longer term position. Alright, now that you learned how different types of traders are categorized and what time frames are suitable for them, I want to teach you how you can analyze multiple time frames to increase the probability of finding profitable trading opportunities in the market. Multiple time frame analysis is a trading method that you monitor the same asset on different time frames. There is a general guideline for choosing multiple time frames. 3 different time frames can give you enough information about the market. Less than 3 can be insufficient, and more than 3 is unnecessary and waste of time and energy and cannot add any considerable value to the result. So 3 time frames are enough to effectively analyze the market. A very simple strategy is to use ratio of 1:4, 1:5, and 1:6 depending on if they are applicable to your trading platform. These ratios give enough room to your time frames for showing enough data of the market. Basically, 1 is your medium-term time frame, 1 short-term time frame, and 1 long-term time frame. Let me give you an example so you can better understand it. First, we start with medium-term time frame. This time frame should be matched with your trading style and also your trading strategy. Consider I am a swing trader and I want 4 hours time frame to be my main chart for analysis. So this is my medium-term time frame. Now I must choose the long-term time frame. I use ratio of 1:6, and 1 day time frame becomes my long-term time frame. And for short-term time frame, I use ratio of 1:4, and 1 hour would be my short-term time frame. So 1 hour, 4 hours, and 1 day time frames are the ones that I use for analyzing the chart. 4 hours time frame, the medium-term time frame, is my main chart, and most of my analysis is done here. The 1 day time frame, the long-term time frame, is used for identifying major trends and support and resistance levels of the market. I want to be sure that I'm in the same direction with longer term trend of the market, and I use 1 hour time frame for precise entry and exit points. Consider I have a buy signal here. As you can see, the price is apparently in an uptrend. Should I enter? No, because if I switch to my long-term time frame, which is 1 day time frame, I can see that the longer term trend is down with a downtrend line like this. Actually, the downtrend started from here. Here we had a large pullback, and again the price is going down. down. Here we were in an uptrend and here we are in a downtrend. So this uptrend that we see here on 4 hours time frame, I mean here, this is just a pullback within the longer term downtrend, which we identified on 1 day time frame. And it's very probable if the price advances and reach to around here, it will stop and decline because this downtrend line is acting like a resistance level. And we expect that we will have declining of the price if the price hit this level. So on 4 hours time frame, if we have a buy signal here, we should not enter because our long-term time frame, on daily time frame, we are in downtrend and this is just a pullback within that downtrend. But if we get a sell signal around here, the sell signal is confirmed by our long-term time frame, and then we can switch to 1 hour time frame, which is our short-term time frame, to find precise entry points. For example, breaking below a support level can give us a signal to enter the trade. This was an example of choosing time frames for a swing trader who is focused on 4 hours time frame, and you can do it similarly with other time frames. For example, if you're a day trader and you want to choose 15 minutes time frame as your medium term time frame, then 1 hour time frame could be your long term time frame and 3 minutes time frame as your short term time frame. Or you can also choose 5 minutes time frame if 3 minutes is not available on your platform. There is no hard rule and those ratios are just a guideline to help you with the time frames. In practice, all we need is 3 different time frames with enough distance from each other but not too far that can provide us relative information from short term to long term view. This method of multiple time frame analysis is called top-down analysis because, as you saw, our longer term time frame has priority in terms of significant levels of the market. We conclude the major trends of the market or major support and resistance levels from our long-term time frame, and they have priority in compared to our mid-term time frame. And then on mid-term time frame, our strategy of finding buy sell signals is executed, and then on short-term time frame, after having a confirmed signal, we can find a precise entry point. Some traders prefer not to go to shorter time frame and they enter a position when they have a confirmed signal, but some other traders prefer to fine-tune their trade entries for maximum profit. By the help of top-down analysis, you can be sure that you are entering in the same direction of the longer-term trend of the market, not against it, so you will have significantly higher probability to have a profitable trade. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.